Ever wondered how options trading works? It's a fascinating realm of finance that allows you to speculate on the future price of an asset without having to own it. At its core, options trading revolves around two key types: call options and put options. A call option is a contract that gives you the right, but not the obligation, to buy an asset at a predetermined price within a specific time frame. On the flip side, a put option is a contract that gives you the right to sell an asset at a predetermined price within a specific time frame. The intriguing aspect of options trading is the risk and reward scenario. While the potential for high returns is attractive, it's vital to remember that losses can also be significant. It's this balance of risk and reward that makes options trading an intriguing pursuit for many. Now let's delve deeper into the world of options trading. So what exactly are call options? In the simplest terms, a call option is a contract giving you the right, but not the obligation, to buy a specific amount of an underlying asset, say a stock, at a predetermined price within a specified time frame. This predetermined price is known as the strike price, and the specified time is called the expiration date. Imagine a call option as a coupon. Let's say you have a coupon that allows you to buy a gallon of milk for $2 at any time within the next month. If the price of milk rises to $3, you can use your coupon and save $1. But if the price of milk falls to $1, you can choose not to use your coupon and just buy the milk at the lower price. That's how a call option works. Now let's dive a bit deeper. In options trading, there are two positions one can take: buying a call option or selling a call option. When you buy a call option, you pay a premium for the right to purchase the underlying asset at the strike price. If the price of the asset rises above the strike price before the expiration date, you can exercise your option and buy the asset at the lower price, potentially making a profit. On the other hand, when you sell a call option, you collect the premium but accept the obligation to sell the asset at the strike price if the buyer decides to exercise the option. If the price of the asset doesn't rise above the strike price, the option expires worthless, and you get to keep the premium as your profit. Call options can be a powerful tool in the hands of savvy traders, allowing them to leverage their capital, hedge against potential losses, and speculate on market movements. But as with any financial instrument, they come with their own set of risks and should be used wisely. That wraps up the basics of call options. But what about put options? Now let's shift our focus to put options. Put options are the flip side of the coin to call options. They are financial contracts that give the buyer the right, but not the obligation, to sell a specific amount of an underlying asset at a predetermined price, known as the strike price, within a specified time frame. This time frame ends on the option's expiration date. When you buy a put option, you're hoping the price of the underlying asset will decrease. If it does, you can sell it at the higher strike price rather than the market price, making a profit. For example, if you buy a put option with a strike price of $100 for an asset that later falls to $80, you can still sell it for $100, pocketing the difference. Now, what about selling put options? When you sell a put option, you're essentially betting that the price of the underlying asset will stay the same or increase. As the seller, you're obligated to buy the asset at the strike price if the buyer chooses to exercise their option. So if the market price stays above the strike price, the buyer won't exercise their right to sell, and as a seller, you keep the premium paid by the buyer. But beware, if the price falls below the strike price, you're obligated to buy the asset at the higher strike price, potentially incurring a loss. Remember, buying put options can be a way to profit from a downturn in the market or to protect a long position. Selling put options, on the other hand, can generate income, but comes with the risk of being obligated to buy the asset if its price falls. So, put options, like call options, can be used strategically to anticipate market movements and hedge against potential losses. They are a useful tool in the trader's arsenal, offering a way to capitalize on market volatility and protect investments. With the understanding of call and put options, we can now explore options trading strategies. Ready to learn some basic options trading strategies? Let's dive right in. First up is buying calls. This strategy involves purchasing a call option when you anticipate that the underlying stock's price will increase. It's a bullish strategy, meaning it's based on the expectation of rising prices. The potential profit is unlimited, as the stock price could theoretically rise indefinitely. However, the risk is limited to the amount paid for the option. Next, we have buying puts. This is the opposite of buying calls. You buy a put option when you expect the underlying stock's price to decrease. It's a bearish strategy, betting on falling prices. Like buying calls, the risk is limited to the amount paid for the option, but the potential profit is substantial if the stock price drops significantly. Then there's selling covered calls. This strategy involves owning the underlying stock and selling call options against it. This is a neutral to slightly bullish strategy. The potential profit is limited to the premium received from selling the call, plus any appreciation in the stock, up to the strike price. The risk, however, is that the stock could fall, and you're left holding shares that have depreciated in value. Lastly, let's talk about selling puts. This strategy involves selling put options with the hope that they expire worthless, allowing you to pocket the premium. It's a neutral to slightly bullish strategy. The potential profit is limited to the premium received, but the risk can be substantial if the stock price falls significantly below the strike price. These strategies provide a basic framework for trading options, but remember, they are not without risk. Each strategy requires careful consideration of the underlying stock's price, the strike price, and the expiration date, not to mention the stock market's overall condition. Remember, each strategy comes with its own set of risks and rewards. Understanding these can help you make informed decisions and potentially pave the way for successful trading. Timing is everything in options trading. Let's delve into why this statement holds so much weight. In options trading, there's a ticking clock that works either for you or against you, and it's known as the expiry date. This expiry date on an options contract can have a significant impact on the success of your trade. Think of it as a deadline. If the market conditions align with your prediction before this deadline, you're in the money. But if the market moves against you, or if it doesn't move far enough in your favor before the expiry date, you could stand to lose your entire investment. Options trading isn't just about predicting the direction of a stock's price movement. It's also about accurately forecasting when this movement will occur. Misjudging this timing can lead to missed opportunities or losses. So, as you see, timing can make or break your options trading strategy. Let's recap what we learned today. We've taken a comprehensive journey into the world of options trading, starting with the absolute basics. We've built a solid foundation, enabling us to confidently navigate the complex landscape of options trading. Firstly, we introduced the concept of options trading. We learned that an option is a contract giving the buyer the right, but not the obligation, to buy or sell an underlying asset at a predetermined price within a given time frame. This fundamental understanding sets the stage for everything else in options trading. Next, we delved into the specifics of call options, which give the holder the right to buy an asset at a specified price. We discussed how investors use call options when they anticipate that the price of an underlying asset will increase. Following this, we explored put options. These are contracts that give the holder the right to sell an asset at a specified price. We learned that investors use put options when they expect the price of an underlying asset to decrease. Moving forward, we examined some basic options trading strategies. We discovered how we can combine calls and puts in various ways to create different strategies, each serving a unique purpose and catering to different market outlooks. Then we discussed the importance of timing in options trading. We highlighted that the value of an option is highly sensitive to time, because as an option reaches its expiry date, the probability of making a profitable trade decreases. In conclusion, we reiterated the importance of understanding these basics before diving into the world of options trading. It's like learning to swim before jumping into deep waters. The knowledge we've acquired today provides us with the tools we need to navigate the complex and often volatile world of options trading. Remember, options trading can be profitable, but it also comes with high risks. So always do your homework before diving in.
Have you ever wondered how traders manage to keep their portfolios risk-averse, even when the market is highly volatile? The answer lies in delta hedging and volatility trading strategies. These are fundamental tools that traders use to navigate the uncertain waters of the financial markets. They help to manage risk, optimize profits, and maintain a balanced portfolio in the face of market volatility. Delta hedging, a strategy that aims to reduce or eliminate the risk associated with price movements in an underlying asset, is a key player in this game. On the other hand, volatility trading strategies capitalize on the ups and downs of the market, turning volatility into an opportunity rather than a threat. Together, these strategies form a powerful arsenal for any trader looking to thrive in the dynamic world of trading. Stay tuned as we unravel the concepts of delta hedging and volatility trading strategies. First, we delve into the realm of delta hedging, a strategy that aims to reduce or eliminate the risk associated with price movements in the underlying asset. Now, let's break it down a bit. In the world of options trading, delta is a Greek term that represents the rate of change of the price of an option with respect to changes in the price of the underlying asset. It's a measure of how much the price of an option is expected to change when the price of the underlying asset changes by 1 unit. But how does this relate to delta hedging, you might ask? Well, delta hedging is a strategy that uses this very concept, the delta, to create a portfolio that is insensitive to small changes in the price of the underlying asset. This strategy involves adjusting the options position according to the delta, hence the name, delta hedging. Imagine you are a trader with a portfolio of options. The market is volatile, and the prices of the underlying assets are fluctuating. Without any protective measures, your portfolio is at risk. This is where delta hedging comes into play. By using delta hedging, you can adjust your portfolio positions in a way that the overall delta of your portfolio is zero. This means that for small changes in the price of the underlying asset, the value of your portfolio remains unchanged. The portfolio is, in essence, hedged against price movements in the underlying asset. This process of constant adjustment is often referred to as rebalancing, and while it may seem like a lot of work, many traders find it worth the effort, as it helps to create a risk-neutral portfolio. And there you have it, delta hedging in all its glory. It's a powerful tool, allowing traders to navigate the choppy waters of the financial markets with greater ease and security. With delta hedging, you can create a risk-neutral portfolio, irrespective of the market's movements. Now that you know what delta hedging is, let's discuss how it's done. Delta hedging is a strategy used in options trading to reduce or eliminate the risk associated with price movements in the underlying asset. The process can be a bit intricate, but it's all about balancing the scales. Imagine you're a trader. You've bought an option, which gives you the right to buy or sell a particular asset. However, the asset's price is a wild horse, constantly galloping up and down. This price movement creates risk. What if the price moves in the opposite direction of what you had anticipated? This is where delta hedging comes into play. The first step in the delta hedging process is to determine the delta of your option. The delta is a measure of how much the option's price is expected to change with a $1 change in the price of the underlying asset. If the delta is positive, the option's price will increase if the asset's price increases, and vice versa. If the delta is negative, the option's price will decrease if the asset's price increases, and vice versa. Once you've determined the delta, the next step is to take an offsetting position in the underlying asset. If the delta of your option is positive, you would sell shares of the underlying asset. If the delta is negative, you would buy shares. The number of shares you buy or sell is equivalent to the delta of your option. By taking this offsetting position, you are hedging your risk. If the price of the underlying asset moves in a direction that would cause you to lose money on your option, you'll make money on your offsetting position and vice versa. The final step in the delta hedging process is to continuously monitor and adjust your positions. As the price of the underlying asset changes, so does the delta of your option. You'll need to adjust your positions accordingly to keep your portfolio's delta at zero. Remember, the objective of delta hedging is to bring the portfolio's delta to zero, effectively neutralizing the risk. Moving on from delta hedging, we now enter the domain of volatility trading strategies. This type of trading strategy is a fascinating realm of possibilities, where the focus shifts from the direction of the asset's price movement to the instability or volatility of that asset. Now you might wonder, how can traders profit from volatility? The answer lies in understanding that volatility represents uncertainty and risk. And where there's risk, there's potential for substantial reward. In essence, Volatility trading strategies are designed to take advantage of the price fluctuations of an asset, rather than predicting the asset's direction. This approach opens up a world of opportunities, as traders can profit in both rising and falling markets. Let's break it down. In a volatile market, asset prices swing wildly, and this unpredictability can create a trading environment ripe for strategic moves. Traders can use various financial instruments like options and futures to bet on the magnitude of price changes rather than the direction of the price itself. For instance, imagine a stock whose price bounces around wildly throughout the day. A trader employing a volatility strategy might buy an option on that stock, betting that the stock's volatility will continue or increase. If the stock's price swings become more dramatic, the option's value could rise, providing the trader with a profit. However, it's crucial to remember that volatility trading is not a one-size-fits-all strategy. It requires a deep understanding of market dynamics, a keen eye for spotting trends and patterns, and a robust risk management framework. Moreover, volatility can be a double-edged sword, offering the potential for significant profits, but also posing substantial risks. Hence, it's essential to approach this strategy with caution, always considering the potential downsides and setting stop losses appropriately. In volatility trading, it's not the direction of the market, but its instability that presents opportunities. It's about embracing the chaos, harnessing the power of uncertainty, and turning it into a profitable trading strategy. Remember, in the realm of volatility trading, it's the storm you chase, not the calm. Knowing what volatility trading is, it's time to understand how to implement it. Volatility trading involves a number of strategies, each with its own unique approach to harnessing market fluctuations. Let's dive in and explore a few of these. First up, we have the straddle strategy. This involves purchasing a call and a put option at the same strike price. The idea here is to profit from a significant movement in the underlying asset's price, regardless of the direction. It's a strategy that can be particularly effective when you expect high volatility but are uncertain about the direction of the price movement. Next, we have the strangle strategy. This is similar to a straddle, but instead of buying options at the same strike price, you're buying a call and a put option at different strike prices. The strangle strategy can be a bit more cost-effective than a straddle, but it requires a larger price movement to become profitable. Lastly, let's talk about the butterfly strategy. This is a bit more complex. It involves buying or selling two options at the same strike price, and then buying or selling another two options at two different strike prices. The aim here is to profit from low volatility in the market. If the price of the underlying asset remains within a small range, the butterfly strategy can provide substantial returns. Each of these strategies has its strengths and weaknesses, and it's important to understand them thoroughly before diving in. The right strategy for you will depend on your risk tolerance, market expectations, and overall trading objectives. Remember, the key to successful volatility trading is to anticipate changes in market volatility. With a keen eye on market trends and a solid understanding of volatility trading strategies, you can harness market volatility to your advantage, turning uncertainty into opportunity. As always though, it's crucial to approach trading with a disciplined mindset and a well-thought-out plan. It's not just about predicting market movements, but also about managing risk and making informed decisions. Let's conclude by highlighting the key points from our discussion. We've explored delta hedging, a technique that adjusts the number of options relative to the underlying asset to neutralize price risk. This strategy is crucial in creating a state of indifference to market movements, allowing traders to manage risk effectively. We've also delved into volatility trading strategies, which capitalize on market volatility. These strategies, such as straddles, strangles, and iron condors, leverage the unpredictability of the market to generate profits. They are instrumental in profiting from market volatility, even when the direction of the price movement is uncertain. Remember, both delta hedging and volatility trading strategies are not mere tactics. They are essential tools in a trader's toolkit, enabling you to manage risk and profit from market volatility. And there you have it. With delta hedging and volatility trading strategies, you can navigate the unpredictable world of trading with confidence.
Ever wondered why understanding option pricing is crucial in the finance world? Well, let's delve into this fascinating topic. In essence, option pricing is the heartbeat of financial markets. It's like a compass guiding investors through the challenging terrain of the financial landscape. Option pricing plays a critical role in risk management. By accurately estimating the value of an option, investors can better hedge their bets, protecting themselves from potential market downturns. It's a bit like an insurance policy against market volatility, but it doesn't stop there. Option pricing is also a key tool in strategic investment. It helps investors identify lucrative opportunities, allowing them to maximize their gains. Moreover, option pricing is fundamental to financial forecasting. It provides valuable insights into market trends and potential shifts, helping to predict the financial weather, if you will. So comprehending option pricing is not just beneficial, but essential for anyone venturing into the finance sector. Enter the Black-Scholes model, one of the most influential concepts in modern finance. This pioneering model was introduced in the early 70s by economists Fisher Black and Myron Scholes, with crucial contributions from Robert Merton. Often considered a cornerstone of financial theory, the Black-Scholes model revolutionized the world of finance. It became the standard for option pricing, playing a vital role in the explosive growth of the options market. But what is it exactly? Well, it's a mathematical model designed to calculate the theoretical price of options. Or in simpler terms, it's a formula to figure out how much an option should cost. It considers various factors like the current stock price, the option's strike price, time until expiration, risk-free interest rate, and the stock's volatility. In essence, the Black-Scholes model is a mathematical approach to pricing options. But how does it work? The secret sauce of the Black-Scholes model lies in its 5 major components. Let's dive into these components and see how they blend together to give us the price of an option. The first ingredient in our secret sauce is the stock price. This is the current price of the underlying asset, such as a share of stock at the time we're calculating the option price. It stands to reason that if a stock's price is high, call options on that stock will be more valuable since they give the holder the right to buy the stock at a predetermined price. Conversely, put options, which give the holder the right to sell, become more valuable when the stock price is low. Next, we have the strike price. This is the predetermined price at which the holder of the option can buy or sell the underlying asset. Naturally, the more favorable the strike price is in relation to the current stock price, the more valuable the option. Thirdly, we have the time to expiration. This is the period from the present time until the option contract expires. The more time an option has before it expires, the more valuable it is. This is because the longer the time period, the higher the chance that the stock price will move favorably for the holder of the option. Now let's stir in some volatility. Volatility is a measure of how much the stock price is expected to fluctuate during the life of the option. High volatility increases the chance of the stock price moving favorably for the option holder. Hence, the higher the volatility, the higher the option price. Finally, we add a pinch of risk-free interest rate. This is the return that could be earned on a risk-free investment, such as a government bond. The higher the risk-free interest rate, the more valuable the option. This is because the cost of holding the option, which is the foregone interest that could have been earned on the money spent to buy the option, increases as the risk-free interest rate rises. Once we have all these ingredients, we blend them together using the Black-Scholes formula. This formula takes into account how these factors interact with each other to calculate an option's price. For instance, an increase in stock price or volatility can increase the price of a call option, while an increase in the strike price or the risk-free interest rate can decrease it. So there you have it. The Black-Scholes model is like a recipe for option pricing, with each component playing a crucial role. It's important to note, however, that this model provides only a theoretical estimate. In the real world, other factors such as dividends, transaction costs, and the possibility of early exercise can also influence an option's price. Through these steps, the Black-Scholes model provides a theoretical estimate of an option's price. Like any model, the Black-Scholes operates on certain assumptions. It's important to understand these assumptions because they form the foundation of the model and significantly influence its outputs. Firstly, the Black-Scholes model assumes that stock prices follow a log-normal distribution. This means the model assumes that stock prices can theoretically go to infinity but cannot fall below zero. The log-normal distribution also suggests that stock price changes are random, and future price changes are independent of past price changes. The second assumption is constant volatility. The Black-Scholes model assumes that the volatility of the underlying asset is constant over the life of the option. In reality, this is rarely the case. Volatility tends to fluctuate depending on a variety of factors like market sentiment, economic indicators, and corporate news. The model also assumes that there are no transaction costs when buying or selling the option or the underlying asset. This means the model operates under the assumption of frictionless markets, where all transactions are costless and instantaneous. However, in the real world, brokers charge fees and there can be significant time lags in execution. Another assumption is that the risk-free rate of return is constant over the life of the option. This is the theoretical return of an investment with zero risk. But in reality, the risk-free rate can change due to factors like monetary policy and macroeconomic conditions. Lastly, the model assumes European-style options, which can only be exercised at expiration. This contrasts with American-style options, which can be exercised any time before expiration. These assumptions, while simplifying the model, can also limit its real-world applicability. They create an idealized world that often does not fully reflect the complexities and unpredictability of financial markets. As such, while the Black-Scholes model is a powerful tool for understanding option pricing, it's essential to remember that its accuracy is dependent on these assumptions holding true. So, what should you take away from all this? We've embarked on a fascinating journey through the world of option pricing, steering our course with the Black-Scholes model as our guiding compass. Let's take a moment to reflect on what we've learned and why it's so crucial. Firstly, we delved into the importance of understanding option pricing. It's the beating heart of the financial world, driving decisions that shape economies, businesses, and individual fortunes. The ability to accurately price an option is akin to having a crystal ball, providing insights into potential futures and helping to mitigate risks. Next, we introduced the Black-Scholes model, a mathematical marvel that revolutionized the financial industry. Named after economists Fisher Black and Myron Scholes, this model provides a theoretical estimate of the price of European-style options. We then walked you through the steps of the Black-Scholes model. Remember, it's a 5-step dance. Begin with the current stock price, then factor in the strike price, time until the option's expiration, the risk-free interest rate, and finally, the stock's volatility. The harmony of these factors gives us the theoretical price of an option. But like all models, the Black-Scholes model is built on certain assumptions. It assumes that markets are efficient, that the risk-free rate and volatility are constant, and that there are no transaction costs or dividends. It also assumes that the stock price follows a geometric Brownian motion with constant volatility. These assumptions, while simplifying the model, also represent its limitations. Despite these limitations, the Black-Scholes model has left an indelible imprint on modern finance. Its influence extends far beyond option pricing, shaping theories and strategies across the financial universe. It has served as a foundation for the development of complex financial instruments and trading strategies. It has also fueled advancements in financial risk management, inspiring new ways to measure and manage risk. Yet, the Black-Scholes model is not a definitive answer but a tool. It's a starting point, a framework to build upon, and a lens to view the complex world of finance. It doesn't remove the inherent uncertainty of markets but helps us navigate it with greater confidence and insight. The Black-Scholes model, with all its elegance and imperfections, is a testament to the power of mathematical modeling in finance. It underscores the importance of continuous learning, critical thinking, and adaptation in a field that is ever-evolving and full of surprises. In conclusion, understanding the Black-Scholes model is not just about learning a formula. It's about appreciating the complexities of the financial markets, the interplay of various factors influencing option pricing, and the role of mathematical models in deciphering this complexity. Understanding the Black-Scholes model is a stepping stone into the world of finance, a world where option pricing plays a pivotal role.
Ever wondered how sensitivity analysis can help in strategy planning for complex options? Well, you're in the right place. Sensitivity analysis, at its core, is a technique used to determine how different values of an independent variable impact a particular dependent variable under a given set of assumptions. In simpler terms, it helps us understand how varying one factor can influence the outcome of a situation or model. It's like tweaking the ingredients of a recipe to see how it affects the final dish. A pinch more salt, a dash less pepper, maybe switch out the chicken for tofu. Each change alters the dish in a different way, and sensitivity analysis helps us understand these alterations. But why is it important? Sensitivity analysis provides valuable insights that help in decision-making. It helps identify critical variables and assess risk, allowing us to make informed decisions and create robust strategies. It's like a compass in the wilderness of uncertainties, guiding us towards the most optimal path. Now let's talk about the application of sensitivity analysis in different scenarios. It's used in a wide range of fields, from engineering to finance and even in environmental studies. In finance, for instance, sensitivity analysis assists in evaluating the uncertainty surrounding the outcome of an investment decision. It helps identify which variables are most impactful and thus where to focus resources and efforts. And this brings us to the fascinating world of strategy planning for complex options. Complex options strategies involve multiple variables and assumptions, making them perfect candidates for sensitivity analysis. By understanding how each variable affects the outcome, we can craft a strategy that optimizes returns while managing risk. So, sensitivity analysis isn't just a fancy term thrown around in boardrooms. It's an essential tool that helps navigate the complexities of decision-making in uncertain environments. It's the secret sauce that can turn a good strategy into a great one. Now that you have an understanding of what sensitivity analysis is, let's delve into how it plays a crucial role in strategy planning for complex options. So, how does one conduct a sensitivity analysis? Let's take a look at the step-by-step process. First, we start with data collection. This can involve a wide variety of sources, from financial reports and market research to expert opinions and historical data. The objective here is to gather as much relevant information as possible to feed into our analysis. Next, we move to model creation. This involves translating the data collected into a mathematical or statistical model that represents the situation we're analysing. This could be a simple linear regression model or a complex multivariate model, depending on the complexity of the situation. Once we have a model, the next step is variable selection. It involves identifying which variables in the model we want to test for sensitivity. These are typically the variables that we think might have a significant impact on the outcome or that are subject to uncertainty. This could include factors like interest rates, exchange rates, or commodity prices in a financial context. Now, we're ready to run our sensitivity analysis. Using various methods and tools, we manipulate the chosen variables within their feasible ranges and observe the corresponding changes in the outcome. This could be done manually or with the help of software tools that automate the process and allow for more complex analyses. Finally, we come to result interpretation. This is where we draw conclusions from our analysis and make decisions. If a small change in a variable leads to a large change in the outcome, that variable is said to be highly sensitive. Conversely, if a large change in a variable leads to only a small change in the outcome, that variable is less sensitive. Now keep in mind, each of these steps can be nuanced and complex, depending on the specifics of the situation. But having a clear understanding of the process is the first step in effectively leveraging sensitivity analysis. With a clear understanding of the process, we can now explore how sensitivity analysis aids in strategy planning for complex options. Complex options strategies require careful planning. But how does sensitivity analysis fit into this? Well, let's dive into it. To start, we need to understand that complex option strategies are a bit like a game of chess. Each move or decision can have a significant impact on your overall strategy. So it's crucial to plan ahead and consider all potential outcomes. This is where sensitivity analysis comes into play. It's a tool that helps us identify the key variables that can impact our strategy's success. These could be factors like price volatility, interest rates, or time to expiration. Sensitivity analysis allows us to see how changes in these variables might affect our strategy's profitability. Imagine it as a weather forecast for your strategy. Just as a meteorologist uses models to predict how changes in atmospheric conditions might affect tomorrow's weather, we use sensitivity analysis to predict how changes in market conditions might affect our strategy's outcome. Now, identifying these key variables is only half the battle. We also need to understand the potential risks associated with each variable. This is known as risk analysis, and it's an integral part of sensitivity analysis. Think of it this way: if we know that a thunderstorm is likely tomorrow, we can plan accordingly. We might decide to pack an umbrella or postpone our picnic. Similarly, by identifying the potential risks in our strategy, we can take steps to mitigate them. We might decide to hedge our positions or diversify our portfolio. But remember, just as the weather forecast is not always accurate, the same goes for sensitivity analysis. It's a predictive tool, not a crystal ball. It's based on assumptions and models, which means it has its limitations. But despite these limitations, it provides a robust framework for understanding the potential outcomes of our strategy and the risks involved. So to wrap up, sensitivity analysis is a powerful tool in our arsenal when planning for complex options strategies. It helps us identify key variables, understand potential risks, and make informed decisions. Sensitivity analysis provides a robust framework for strategy planning for complex options, but how does it all come together? Well, stay tuned for the next scene where we'll see sensitivity analysis in action. Now let's see how sensitivity analysis works in a real-world scenario. Imagine you're a financial analyst at a multinational corporation. You're tasked with strategy planning for complex options. Your goal is to make informed decisions, manage risk, and optimize strategy. This is where sensitivity analysis comes into the picture. Let's say you're considering two different options strategies. Strategy A has higher potential returns, but also a higher level of risk. Strategy B, on the other hand, offers more moderate returns, but carries less risk. How do you decide which strategy to pursue? This is where sensitivity analysis shines. You use this tool to examine how different values of an independent variable impact a particular dependent variable under a given set of assumptions. In this case, the independent variables could be market volatility, interest rates, or time to expiration, while the dependent variable is the option price. So, you begin by changing the values of these independent variables. You observe how these changes affect the dependent variable, the options price. You might find that a slight increase in market volatility significantly impacts the price of strategy A, while having a minimal effect on strategy B. This means strategy A is more sensitive to changes in market volatility. Understanding this sensitivity is pivotal. It helps you weigh the potential risks against the potential rewards of each strategy. You can now make an informed decision based on the results of your sensitivity analysis. You might choose strategy B if you want to be more conservative and avoid the potential volatility, or you might choose strategy A if you're willing to take on more risk for the chance of higher returns. The beauty of sensitivity analysis lies in its simplicity. It provides a clear, quantitative measure of risk, helping you make smarter, more informed decisions. It's a powerful tool for financial analysts, aiding in risk management and strategy optimization. As you can see, sensitivity analysis plays a vital role in strategy planning for complex options. So, what have we learned today? We've embarked on a journey through the intricate world of sensitivity analysis and strategy planning for complex options. We've peeled back the layers of these concepts, understanding their significance and how they intertwine in the realm of financial analysis. Let's take a moment to revisit the key touchpoints. We started with sensitivity analysis, an essential tool for any financial analyst. It's a process that reveals how different values of an independent variable will impact a particular dependent variable under a given set of assumptions. It's akin to a compass, guiding us through the uncertainty of financial projections and forecasts. Our journey then led us to the heart of strategy planning for complex options. We discovered that options aren't just a gamble, they're an opportunity. With the right strategy, they can become a powerful instrument in our financial symphony, providing us with a variety of ways to profit from the inherent volatility in the markets. And how does sensitivity analysis fit into this picture? It's the bridge that connects our understanding of the market conditions with the strategies we employ. By understanding the sensitivity of our options to changes in market variables, we can make better informed decisions and craft strategies that are resilient and adaptable. We've also seen sensitivity analysis in action, illustrating its practical applications and reinforcing its pivotal role in strategy planning. It's not just theory, it's a practice that can yield tangible benefits. It helps us to anticipate changes, assess risks, and seize opportunities, making it an invaluable tool in our financial toolkit. As we wrap up, let's remember that sensitivity analysis isn't a mere technique. It's a lens through which we view the world of complex options strategies. It's a mindset that encourages us to question, to probe, and to understand the underlying dynamics of our decisions. Remember, sensitivity analysis isn't just a tool, it's a mindset that can help you navigate the complex world of options strategies.
Ever pondered why one should consider building an options portfolio? Let's dive into it. Building an options portfolio is more than just about buying and selling. It's about strategy. It's about taking control of your financial future. One of the major advantages is the ability to generate income. Options can be sold to earn a premium, which is a great way to generate income regardless of the market's direction. You can think of this like renting out your stocks, and who wouldn't love some extra cash from their investments? But the benefits don't stop there. An options portfolio can also serve as a hedge against other investments. This means that it can help protect your portfolio from adverse market movements. It's like an insurance policy for your investments. If the market dips, your options can help offset the losses. Now let's talk about leverage. Leverage allows you to control a large amount of stock for a relatively small amount of money. This means you can potentially achieve bigger profits compared to owning the underlying stock outright. But remember, with great power comes great responsibility. Leverage can amplify your gains, but it can also magnify your losses. Finally, let's not forget about diversification. An options portfolio allows you to spread your investments across different sectors, reducing the risk of being too heavily invested in one area. It's like not putting all your eggs in one basket. Diversification can help smooth out the bumps in the road, leading to a more stable and consistent growth in your portfolio. So there you have it. Building an options portfolio can provide you with income, protect your investments, offer leverage, and promote diversification. It's not just about making money, it's about creating a strategy that aligns with your financial goals and risk tolerance. So, it's clear that an options portfolio can be a powerful tool in an investor's arsenal. But how does one manage the risks associated with options trading? Well, this is where the concept of risk diversification comes into play. Essentially, risk diversification is a strategy that mixes a wide variety of investments within a portfolio. The rationale behind this technique contends that a portfolio of different kinds of investments will, on average, yield higher returns and pose a lower risk than any individual investment found within the portfolio. In the context of options trading, risk diversification helps to mitigate the potential damage of a single option's poor performance on the overall portfolio. It's not about avoiding risk altogether, but rather spreading it out so that any one setback doesn't sink the entire ship. By diversifying, you're not putting all your eggs in one basket, but rather spreading them across multiple baskets. Risk diversification, therefore, plays a crucial role in managing the uncertainties of options trading. Now, how does one go about building an options portfolio? That's an excellent question and one that we're going to dive into right now. First things first, it's crucial to have a solid understanding of the basics of options. Options are contracts that give the holder the right, but not the obligation, to buy or sell an underlying asset at a predetermined price before or on a specific date. It's a bit like having a reservation at a restaurant. You have the right to take the table if you want, but you're not obligated to do so. Once you've grasped the concept of options, the next step is identifying your investment goals. Are you looking to generate income, hedge against potential losses in your portfolio, speculate on market movements, or perhaps a combination of these? Your goals will dictate the strategies you employ in your options portfolio. It's a bit like deciding on what kind of meal you want to cook. Your ingredients and cooking method will depend on whether you're preparing a quick lunch or a gourmet dinner. Now that you've identified your goals, it's time to select the right options strategies. there are a variety of strategies available, each with its own risk and reward profile. Some popular strategies include buying calls and puts, selling covered calls, and using spreads and straddles. It's a bit like choosing the right tools and techniques for your meal. A frying pan won't be much use if you're planning to bake a cake. Once your strategies are in place, the next step is to build your portfolio. This involves selecting the appropriate options contracts, taking into consideration factors such as the underlying asset, strike price, expiration date, and premium. It's a bit like shopping for your ingredients. You'll need to choose the best quality items that fit your budget and meet your cooking needs. Finally, it's essential to continuously monitor and adjust your portfolio. The market is a dynamic environment, and changes can occur rapidly. Regularly reviewing your portfolio and making necessary adjustments can help you stay on track with your investment goals. It's a bit like tasting your food as you cook and adjusting the seasoning as needed. It ensures the end result is just right. So there you have it, a step-by-step guide to building an options portfolio. Start by understanding the basics of options, then identify your investment goals. Select the right options strategies that align with these goals, and build your portfolio using appropriate options contracts. Regularly review and adjust your portfolio to keep it aligned with your investment goals. Building an options portfolio may seem complex, but with careful planning and execution, it can be a rewarding endeavor. And remember, just like with cooking, practice makes perfect. So don't be afraid to get stuck in and start building your options portfolio today. Having built an options portfolio, how can one diversify the associated risks? This is a question that can keep even the most seasoned investors up at night. Yet, the answer is simpler than you might think. Diversifying risk in an options portfolio involves spreading the risk across different types of options, underlying assets, and expiration dates. This strategy is not about eliminating risk completely. It's about managing and balancing it with the potential for returns. Let's start with diversifying across different types of options. There are two primary types of options: calls and puts. A call option gives you the right to buy an asset at a certain price, while a put option gives you the right to sell an asset at a certain price. By holding both call and put options in your portfolio, you can create a balance. If the market goes up, your call options may increase in value. If the market goes down, your put options may do the same. Next, consider diversifying across different underlying assets. Options can be based on a wide range of assets, from individual stocks to commodities, to indices, and even to currencies. By having options on various types of assets, you reduce the risk of being overly exposed to one particular sector or asset class. If the tech sector takes a hit, but you're also invested in options on commodities or international indices, the impact on your overall portfolio could be cushioned. Diversifying across different expiration dates is another crucial aspect of risk management in an options portfolio. Options come with an expiration date, after which they become worthless if not exercised. By having options with various expiration dates, you're not putting all your eggs in one basket, time-wise. This strategy can help manage the risk of market volatility over time. That said, it's important to remember that while diversification can help manage risk, it's not a guarantee against loss. The options market can be complex and volatile, and it's possible to lose your entire investment in an individual option. This is why it's so important to balance risk with potential return. Make sure you understand the potential downside of each option in your portfolio, and don't invest more than you're willing to lose. Diversifying risk in an options portfolio isn't just about spreading your investments around. It's about carefully considering each option, understanding how it fits into your overall strategy, and making informed decisions based on your risk tolerance and investment goals. Risk diversification in an options portfolio requires careful strategy and execution, but it can greatly enhance the portfolio's resilience and potential for returns. It's a vital part of building a successful options portfolio, and one that every investor should understand. So, what are the key points to remember when building an options portfolio and diversifying risk? First and foremost, an options portfolio is vital for any serious investor. It offers a powerful tool for leveraging your investments and enhancing your potential returns. Secondly, Diversifying risk is not just an option, but a necessity. It's the lifeline that can prevent your portfolio from capsizing in volatile markets. The steps to building an options portfolio are also crucial. Start by defining your investment goals, then select the right options strategy that aligns with these goals. Once you have a strategy, you can choose the options that fit into your plan and monitor them regularly. Finally, diversifying risk in an options portfolio is a strategic move. It's about spreading your investments across different assets, strategies, and time horizons. It's not about avoiding risk altogether, but about managing it in a way that aligns with your investment objectives. Remember, the goal is not to eliminate risk, but to manage it effectively to achieve your investment goals.
Ever wondered how professional traders make money even when the market is falling? Welcome to the fascinating world of options trading, where volatility can be your best friend. Options trading is a financial instrument that lets you speculate on the future price of a stock, allowing you to potentially profit whether prices rise or fall. But remember, with great power comes great responsibility. This method carries significant risks along with its potential rewards. You could lose your entire investment if you're not careful. It's not just about predicting market movements, but also understanding the intricate workings of options and crafting a well-thought-out strategy. A good trading strategy can help manage risk, generate income, and even enhance a portfolio's performance. Now, wouldn't you like to learn how to wield this financial tool like a pro? Today, we'll delve into real-world case studies of various options trading strategies. Imagine you're an investor who owns a significant amount of stock in Company X. Now, you are bullish on this company's long-term prospects, but you're also aware that the stock market can be unpredictable. Maybe there's an earnings report coming up, or perhaps there's some economic uncertainty on the horizon. You're concerned that these factors could lead to a short-term drop in the stock price. This is where the protective put strategy comes into play. A protective put strategy involves buying a put option on a stock that you already own. In essence, this is like buying insurance for your stock. Let's break it down. A put option gives you the right, but not the obligation, to sell a stock at a predetermined price, known as the strike price, before a certain date. If the stock price falls below the strike price, you can exercise the option and sell the stock at the higher strike price. This means that no matter how low the stock price might fall, you're protected because you can always sell at the strike price. Let's say you own 100 shares of Company X, which is currently trading at $50 per share. You decide to buy a put option with a strike price of $45, expiring in 3 months. If the stock price falls to $40, you can still sell your shares for $45 each thanks to the put option. But what if the stock price doesn't drop? What if it rises instead? Well, then you simply let the put option expire worthless. You still own your shares, which have now increased in value, and the only loss you've incurred is the premium you paid for the put option. That's the beauty of the protective put strategy. It allows you to participate in the potential upside of a stock while limiting your downside risk. It's like having your cake and eating it too, but with a small insurance premium. So the protective put strategy can be a safety net, providing insurance against a drop in stock price. Now consider you're an investor with a neutral outlook on the market. In this scenario, you own stocks, yet you anticipate the market to remain relatively stable for a while. Here's where the covered call strategy comes into play. Picture this. You've purchased 100 shares of XYZ Corporation, an established tech giant. You bought them at $100 per share, a total investment of $10,000. However, you don't expect XYZ to skyrocket soon. Instead, you anticipate the stock to remain around the $100 mark for the next few months. So, what can you do to generate some additional income from your XYZ shares during this flat period? You employ a covered call strategy. In essence, you sell call options against your existing stock holding. Each call option represents the right to buy 100 shares of XYZ at a certain price, known as the strike price, within a specific period. Let's say you sell a call option with a strike price of $105, valid for the next 3 months. You receive a premium for selling this option. The premium is income you generate irrespective of whether the option is exercised or not. Now, if the XYZ stock price stays below $105 during the next 3 months, the option you sold will expire worthless. As the seller, you retain the premium and your XYZ shares. If the stock price exceeds $105, the buyer might exercise the option. In this case, you're obligated to sell your XYZ shares at the strike price of $105. But remember, you still keep the premium. In both scenarios, the covered call strategy has allowed you to generate additional income from your existing stock holdings. Even if the market outlook is neutral, you're still making money from the premium. So if you're an investor who can comfortably hold on to shares and weather the flat market, this strategy might be your cup of tea. The covered call strategy can provide a steady stream of income, even in a flat market. What if you're unsure about the direction of the market? This is where the straddle strategy comes into play, an option strategy that can be quite advantageous for an investor who expects a big move in the stock price, but isn't certain about the direction. Let's illustrate this with a case study. Meet Jordan, a savvy investor. Jordan is eyeing a particular stock. Let's call it XYZ. XYZ is set to release its quarterly results soon, and Jordan believes this will cause a significant movement in the stock's price, though he isn't sure whether it will go up or down. This is where the straddle strategy shines. Jordan decides to employ a long straddle strategy. He buys a call option and a put option on XYZ stock at the same strike price and with the same expiration date. The call option will allow Jordan to profit if the stock price rises, while the put option will protect him and allow for profit if the stock price falls. The cost of this strategy for Jordan is the premium paid for both the call and the put option. For the strategy to be profitable, the stock price needs to move more than these combined premiums. The beauty of the straddle strategy is that it doesn't matter which direction the stock price moves. As long as it moves significantly, Jordan stands to profit. As the day of the quarterly results release arrives, the stock price of XYZ surges. Thanks to the call option Jordan purchased, he can now buy the stock at the lower strike price and sell it at the current higher market price, netting a tidy profit. If the stock price had plummeted instead, the put option would have allowed Jordan to still profit by selling the stock at the higher strike price. So, what's the takeaway here? The straddle strategy can be an effective tool when expecting high volatility but are unsure of the direction. It allows for potential profit regardless of whether the stock price goes up or down, as long as the price moves significantly. This strategy, like all investment strategies, carries risk and should be used wisely and within the context of a well-planned investment strategy. Suppose you're an investor expecting low volatility in the market. You're not anticipating any major price swings in the near future. What's the best strategy to maximize your profit in such a scenario? Enter the Iron Condor strategy. The Iron Condor strategy, named after the large-winged bird due to its wide range, is a neutral option strategy that profits when the price of the underlying asset stays within a specified range. This strategy is constructed by simultaneously entering a bull put spread and a bear call spread. Let's assume you're looking at a stock currently trading at $100. You believe the price will stay between $95 and $105 within the next month. To implement the Iron Condor strategy, you would sell a put option with a strike price of $95 and buy another put option with a lower strike price, say $90. This is your bull put spread. Simultaneously, you would sell a call option with a strike price of $105 and buy another call option with a higher strike price, let's say $110. This is your bear call spread. The maximum profit is realized when the stock price stays between the strike prices of the call and put options you sold, that is, between $95 and $105. Your profit will be the total premium received from selling the options minus the premium paid for buying the options. On the other hand, your losses are limited to the difference between the strike prices of the bought and sold options minus the net premium received. This occurs when the stock price moves outside the wider range at expiration. The Iron Condor strategy is a great tool for investors expecting minimal price movement in the underlying asset. It allows you to generate income from a market that is moving sideways. Remember, like any other strategy, it comes with its own risks and rewards. Always consider these factors before diving in. The Iron Condor strategy can be a lucrative option in a low volatility market. Let's revisit the main points about the options trading strategies we discussed. We started with the protective put strategy, a safety net for those wanting to protect their stock investments against a potential drop in price. Then, we delved into the covered call strategy, a play for those bullish on a particular stock but seeking income through selling call options. We moved on to the straddle strategy, ideal for when you predict a big move in the stock price but aren't sure of the direction. Lastly, we looked at the Iron Condor strategy, a complex yet rewarding strategy for those expecting minimal movement in the stock price. Each of these strategies serves different market outlooks and risk tolerances. Understanding them is key to navigating the intricate world of options trading. Remember, options trading carries significant risk. Always consider your financial situation and consult with a financial advisor before making trading decisions.
Ever wondered how the trading cycle in the options market works? Let's dive into it. Options are financial instruments that give you the right, but not the obligation, to buy or sell an asset at a predetermined price within a specific time frame. They're like coupons, but for stocks. Now, the trading cycle in the options market refers to the sequence of events from the time you purchase an option to the time it expires, or you choose to exercise it. It's a bit like a journey with various stops along the way. Understanding this cycle is crucial because it helps you make informed decisions and potentially maximize your returns. It's not just about buying low and selling high. It's about knowing when to hold, when to sell, and when to let an option expire. So buckle up. We're about to embark on a fascinating journey. By the end of this video, you'll have a clear understanding of the trading cycle in the options market. Before we dive into the trading cycle, we need to understand what options are. At their core, options are contracts that give the buyer the right, but not the obligation, to buy or sell an underlying asset at a specific price on or before a certain date. This underlying asset could be a stock, a commodity, or even a currency. Options come in two flavors: calls and puts. Call options give the buyer the right to buy the underlying asset at the strike price, while put options give the buyer the right to sell the underlying asset at the strike price. The strike price is the price at which the underlying asset can be bought or sold, as specified in the option contract. Now, why would anyone want to trade options? Well, options offer several advantages over trading the underlying asset directly. For one, they offer leverage. This means that with a relatively small amount of capital, you can control a much larger amount of the underlying asset. This magnifies your potential profits, but it also magnifies your potential losses. Options also offer flexibility. You can use options to speculate on the direction of the market, to hedge against potential losses in other positions, or to generate income through strategies like writing covered calls. However, options are not without their risks. The price of an option is influenced by several factors, including the price of the underlying asset, the time until the option expires, and the volatility of the underlying asset. Changes in these factors can cause the price of the option to fluctuate, sometimes dramatically. Moreover, unlike stocks, options have an expiration date. If an option is out of the money at expiration, that is, if it would not be profitable to exercise the option, then the option becomes worthless and the buyer loses the entire amount they paid for the option. Now that we understand what options are, let's move on to the trading cycle. The trading cycle in the options market is the process that every options trade goes through. This cycle is the heartbeat of the options market, and understanding it is vital to successful trading. Let's break it down. Imagine the trading cycle as a journey. Where does this journey start? With the initiation of a trade. This is where a buyer and a seller agree to trade an option. The buyer has the right to buy or sell the underlying asset at a predetermined price, while the seller has the obligation to fulfill the contract if the buyer exercises their right. Once the trade is initiated, it moves to the next phase, the trade confirmation. Here, the details of the trade are confirmed and the transaction is recorded. This is like a receipt for your trade, confirming what you bought or sold, at what price, and when. Moving forward, we step into the trade settlement stage. This is where the promises made in the trade are fulfilled. If it's a purchase, the buyer pays the seller, and the seller delivers the option contract to the buyer. If it's a sale, the seller receives the payment, and the buyer gets the option contract. The final step of the trading cycle is the closure of the trade. This happens when the option contract reaches its expiration date. At this point, the buyer can choose to exercise the option or let it expire worthless. If the buyer decides to exercise, the seller must fulfill their obligation. If the buyer lets it expire, the trade is simply closed and the cycle ends. But the options market is not a one-way street. Buyers and sellers can enter and exit trades at any stage of the cycle based on their trading strategy or market conditions. This flexibility is one of the reasons why the options market is so attractive to traders. That is the trading cycle in a nutshell. But how do traders make decisions in this cycle? Stay tuned to find out. Traders use a variety of strategies to make decisions, one of them being pattern recognition. Pattern recognition is a powerful technique used in the world of trading. It's all about identifying patterns in the historical data of asset prices and using those patterns to predict future movements. Let's dive a little deeper into this. Two main types of patterns are commonly sought after: continuation patterns and reversal patterns. Continuation patterns suggest that an existing trend will continue. These might include ascending triangles, descending triangles, or symmetrical triangles. On the other hand, reversal patterns indicate that a current trend is likely to reverse. This could be a head and shoulders pattern, a double top, or a double bottom. The names might sound a bit quirky, but each has a specific shape that traders recognize and respond to. Pattern recognition isn't just about spotting shapes in charts, though. It's about understanding what these patterns mean in terms of market psychology. For instance, the head and shoulders pattern suggests a bullish to bearish reversal. It indicates that buyers initially had control, forming the left shoulder, but then lost momentum, forming the head, and finally sellers took over, forming the right shoulder. Traders also use indicators and tools to help identify these patterns. These might include moving averages, trend lines, or oscillators like the relative strength index or the moving average convergence divergence. These tools help traders to confirm the patterns they see and make more informed decisions. But remember, pattern recognition is not a silver bullet. No strategy is foolproof in the unpredictable world of trading. It's important to use pattern recognition in conjunction with other strategies, risk management, and a solid understanding of the market. In the end, pattern recognition is about making educated guesses, not certainties. It's a tool to help traders tilt the odds in their favor, not a guarantee of success. Pattern recognition is a crucial strategy in options trading. Now, let's summarize what we've learned. So, what have we learned about the trading cycle in the options market and pattern recognition strategies? First off, we've delved into the fascinating world of the options market, a place where traders buy and sell contracts that give them the right, but not the obligation, to buy or sell an underlying asset at a specified price within a certain period. We've discovered that options can be a valuable tool for hedging risk, generating income, and taking advantage of market movements. We then explored the trading cycle in the options market. We learned that this cycle is essentially a series of steps that every trade goes through, from inception to closure. We've understood that it begins with the creation of an options contract, moves to its listing on an exchange, continues with trading between investors, and ends with the contract's expiration or exercise. This cycle is crucial to the functioning of the options market, ensuring that all transactions are carried out smoothly and efficiently. And then we took a deep dive into pattern recognition strategies. We've seen how these strategies can help traders identify trends and anticipate future price movements. Whether it's spotting a head and shoulders pattern signaling a market reversal, or recognizing a bullish flag pattern indicating a potential upward price breakout, these strategies can offer valuable insights to traders. We've also emphasized the importance of these concepts in successful trading. Understanding the trading cycle can help traders navigate the options market more effectively. It can inform their decisions about when to enter or exit a trade and how to manage their risk. On the other hand, mastering pattern recognition strategies can give traders an edge in predicting market movements, allowing them to capitalize on opportunities and avoid potential pitfalls. But let's not forget that while these concepts are important, they're just one piece of the trading puzzle. Successful trading also requires a good understanding of market fundamentals, a sound trading plan, and disciplined risk management. It's about staying informed, being patient, and making decisions based on analysis and strategy, not emotion. And there you have it. We've taken a journey through the trading cycle in the options market and explored the world of pattern recognition strategies. We've learned that these concepts are not just interesting, but also vital for anyone looking to succeed in the options market. So whether you're a seasoned trader looking to refine your strategies or a newbie just starting out, I hope you found this discussion enlightening. Keep learning, keep exploring, and most importantly, keep trading. And that's a wrap on the trading cycle in the options market and pattern recognition strategies. Remember, understanding these concepts is key to your success in options trading.